Hi, everyone. Welcome. This is Gina McDonald from FMA. I know we've got about 1 minute before the top of the hour, but I just wanted to say hello to everyone, make sure technology is working okay, and we'll get started in about a minute. We'll give everyone a chance to log on. Talk to you in 1 minute. Thanks. Okay, good morning, everyone. This is Gina McDonald from FMA. Welcome to a little bit of accounting conversation for about an hour. We're going to talk about new FASB reporting requirements related to nonprofits, and I'm happy to be chatting with you this morning. Here with David Hollander from MBAF. So David also has a quick hello to say to everyone. So take it away, David.
Good morning, everybody. My name is David Hollander. I'm an audit principal here at MBAF. Been with the firm for a little over 24 years. You're in for a real exciting webcast here. We recently did a live 2-day in-person seminar with Gina presenting Is Your Nonprofit FASB Ready? The FASB updates for nonprofit reporting. There's a lot of changes that are coming. The good news is we have a little time before these changes actually occur, but you have to start thinking about them now. And I've been to several of these similar presentations, and I was able to stay awake for the entire hour with Gina. So I think you're in for a real treat with her, and she does a great job of explaining it, because there is some complexity to these changes. But I think after this presentation, you're going to have a much better understanding of the changes and where we're going. And with that, I'm going to let Gina start and lead today's presentation.
Great, thanks. And so just a couple of logistics before we begin. We have an hour, and of course, I know I keep saying about an hour, but I do want to be respectful of everyone's time and schedule. In your webinar controls, there is a question feature. So please feel free, and also we strongly encourage folks to write in questions using that question feature during the webinar. We'll sort of try to keep an eye on those as they come in, but then also leaving time at the end for questions. So please use the question write-in feature. There's also a chat feature on your controls that you might see. That one is a little bit difficult for us to monitor, especially if we've got questions in both places. So please, if you wouldn't mind using the question box, that would be appreciated. And then otherwise, let's get started. We've got a tall order to fill here. As David said, we're going to be riveted, and it's going to be super excited. So you can let me know at the end what you think. So we're here to talk about some new FASB statements, new FASB standards, and I'll tell you in a minute why I shouldn't be saying statements anymore, that affect nonprofit reporting in particular. So we're talking about, in particular, ASU 2016-14, kind of a mouthful. But we know that today FASB issues updates to their accounting standards codification. And when they do that, they use this ASU Accounting Standards Update acronym. And so the first time we heard about these changes coming down the pike was in August of 2016. So that's where this 2016 numbering convention comes from. This is really the first major revision, however, in the requirements around nonprofit external financial reporting since 1993. David certainly was around in 1993. I was around in 1993 using those original FASB statements. That is when FASB old statements numbers 116 and 117 were issued. So for those of us who've been doing accounting with nonprofits for a long time, even folks who've been doing accounting for nonprofits for not that long, that we're familiar with hearing FASB 116 and 117. Also, if we look a few years ago in the notes to our audited financials, we see that those statements are referenced as providing us the guidance for nonprofit financial accounting and reporting. Specifically, that old FASB 117 standard is where we used to go to look for the rules that govern the presentation of nonprofit financials. So it's been way back since 1993. We've been sort of doing everything the same way, and now we're going to have a little bit of a change, and that's why it's important. These changes take effect for calendar reporting, right? So for folks that have a December year end and are going to report on a calendar year 2018 basis, the first year is going to be for that 2018 year. So 12/31/18 financials are going to look different. Or if we are a fiscal year organization, if we have any other year end besides December 31st, the first time we're going to report with this new presentation is going to be fiscal 2019. So some of us are living, right, in the 2018 year where it's going to take effect. Some of us have a little bit more time. Now, this ASU really is focused on, well, we had some runaway slides. This ASU is really focused on how stakeholders, key stakeholders, users of our nonprofit financial statements can better read, understand, and use the information to make decisions. And so we know as nonprofits, lots of folks are interested in our financial information. Internally, we have the governing body. Of course, though, we know we use our audits to make the case for funding. We've got donors, funders, maybe lenders, banks, financial institutions, even the general public at large has access to our financial information, and they're using this financial information to make decisions about funding us, supporting us, things of that nature. Also, there's this focus around financial viability, right? Especially if folks, organizations, corporations, foundations are giving us donations. They want to know how we're using those dollars. They want to know we're here to stay, we're sustainable. In particular, when we see what's involved in this new reporting, we'll notice some key focus areas, in particular around liquidity, right? How are we going to pay our bills? Are we financially viable, let's say? And of course, financial performance and cash flow overall. So this statement or this standard or this update, however we want to refer to it, does not affect accounting in particular. Right now, this accounting standards update is all about financial statement presentation and of course disclosure. So it's the look and feel of our financials. We're not necessarily, which is good news, changing accounting. And although there are a few provisions that are getting a lot of press, we'll say, there are several provisions in this ASU. We're going to talk about these 5 provisions today, and there are a couple others that are not as significant, but the net asset classification, I would say, is the one that's getting a lot of press. We're hearing things like, oh, temporarily restricted is going away, right? I'm sure you guys are hearing that. And of course, that's important, right? We have some new terminology and things of that nature. But liquidity and availability is a provision we're going to talk about. There's new disclosures around that. We're going to understand what's required in terms of disclosure of our functional expenses. We're going to talk about something new and different around presentation of investment expenses, and we're going to also touch base about the way we have to present and disclose information about underwater endowments. Right, so although the net asset classification provision is getting a lot of press, there are some other really key provisions to this update, and we don't want to forget about those. So let's jump into the one that we mentioned is getting lots of press and sort of figure out what's going on with new reporting around net asset classifications. So in a nutshell, we know way back in 1993, FASB introduced 3 classes of net assets. And so of course we've been living with these, for lots of years, 25 years, right? We know we were living with unrestricted net assets, temporarily restricted net assets, and permanently restricted net assets. Of course, we would do our accounting this way. We'd sort of have these 3 categories. But of course, we would report that way as well. So our financial statements would distinguish these 3 classifications. Now we're going to condense and have 2 classifications. This is all about terminology. What was unrestricted net assets, when we do our external reporting, we're now going to relabel that classification as net assets without donor restrictions. Okay, really being specific as to who is doing the restricting and really making it clear that it's an external restriction. Right, so if there are no external restrictions, anything without that external kind of restriction is going to fall into this new without donor restriction bucket. We are going to have a new overarching term for what used to be in our reporting, temporarily restricted and permanently restricted net assets. Those are in a new category called net assets with donor restrictions. So again, really highlighting the fact that it's an external donor who's doing the restricting, right? So FASB thinks that this is more informative to donors or even to folks that aren't experts in reading nonprofit financials and trying to understand what's going on here, right? Can the nonprofit access the dollars or not, or is it a restriction imposed by an external party? So let's take a look and see what the financials might look like with the new naming conventions. So currently and previously now for many years, we might have had a statement of activities or a P&L or an income statement that might have looked like this, where if we had activity in each of our 3 restricted categories, we may have had 3 columns, right? Some of us did it in a little bit different format, where it was more of a stacked or a pancake format you might have heard, but this is very common here, and it's nice to illustrate the breakdown here in columns. Now we know all kinds of things might be in temporarily restricted, time, purpose, right? Program restrictions. When donors give us money, we have to use it on something special, goes in that category. The definition of that is not changing, right? So donors still are going to give us dollars and restrict them for a temporary kind of a nature, right? They're still going to give us items that have restrictions that expire, either based on time or when we use them for the restricted purpose. And of course, we're still going to have things that are restricted in perpetuity. When we have those things, however, we may combine them in one column here now with a new label called with donor restrictions. So what used to be those 2 temp and perm restricted columns could be combined here in a new column called with donor restrictions. So we went from 3 to 2. Now, You may be wondering, well, what's going on here? Because we thought FASB was trying to have these financial statements be more informative to stakeholders. And there was some feedback saying, gosh, it seems like this is less informative, right? It seems like I had breakdown before in knowing what kind of donor restriction was going to expire, what was in perpetuity. And if I've got, those two categories, seems to me like perhaps it was informative to have it broken out. And so FASB agrees with you, and that wants to remind us that there is great flexibility in the presentation. It's okay to disaggregate, right? So we can show more detail. So for instance, even in what is today our unrestricted category, meaning our new without donor restriction bucket, we may have lots of different items in that bucket as well. We may have board designated reserves, things of that nature, right? We may have internally designated in our unrestricted today. FASB saying certainly you can show that detail so long as you head it up, right? So long as you use this new terminology of without donor restriction to define this group of items. Similarly, in our new with donor restriction category, we know we've got all kinds of different donor restricted items. So we know we have time restricted items. We know we have purpose restricted. We know we could have items restricted in perpetuity. And certainly FASB doesn't want us to try and we'll say cloud, the information that now is pretty apparent on the face of our financials, but we just have to remember we want to head up this group with the new title with donor restrictions. So let's look at a couple of examples here where we're sort of embracing this flexibility in presentation. This is a balance sheet or a statement of financial position if we're a nonprofit. And here on the left-hand side, we see the strict interpretation using the new terminology. So in our net asset category, we're just using those two high-level new classifications. So what used to be the unrestricted is now without donor restrictions. We've got $75,000 there we see in our box. With donor restriction, 92,000, and we've got total net assets. So kind of maybe similar to how we have it today, where we have maybe unrestricted and who knows, right? The with donor restriction could be temp and perm today. So if we look, however, in the shaded box in our kind of peach or pink section on the right, this is an alternative presentation. So an option would be that we then show more detail, right? We break out or disaggregate what's in both my without donor restriction category and we break out the with donor restriction category. So we're abiding by the new FASB guidance here because we're using our new terminology. And we are showing more detail. So we're going above the bare minimum requirement, but we're still in compliance and we're providing more information so folks can really see what's in these categories. Okay, so this is an option, right? If we feel like this high level, just two categories, doesn't give enough detail and is not informative. We could also do that on our statement of activities. So for instance, in this presentation, right, this is what used to say, for instance, unrestricted is now without donor restrictions in my first numbered column to the left. But then we've taken the opportunity to break out or disaggregate the with donor restriction category. Again, this particular nonprofit has an endowment and really didn't want to sort of kind of combine the endowment with program restricted items. right? Thinking perhaps that wasn't too informative. In particular, they've got a pretty sizable net asset balance in the endowment here. If we look down to the bottom of that column, they have almost $900,000 of net assets in the endowment. Certainly, I agree, combining that with program restricted items may not be informative, right? We can't tell what's what. So we took the opportunity to sort of break that out, but we're in compliance here with our overarching title with donor restrictions. On the other hand, we might not have complexities in our donor restricted category, but we may have complexities in items we want to break out and disaggregate in what today is our unrestricted. So in the without donor restriction category, we might want to break those out, and there's opportunity there as well. So the message is we have flexibility, all right? And we don't want to feel like we're providing less transparency. And of course, there's ways and we can be in compliance and give all the information we think folks need. Some of us also in the footnotes, right, in our current footnotes to our audited financial statements, some of us give lots of information about the nature of restrictions. However, FASB now in this new ASU has come out and made it mandatory, right? So I think lots of us probably were over compliant with the previous FASB requirements for disclosure. So some of us might feel like, gosh, I already do this. I already disclose the composition of my net assets with donor restrictions. So what we mean is we're going to talk about in the footnotes the nature of the restrictions, the amounts of the restrictions, and potential effects on various types of restrictions. So for instance, some of us have a footnote today that talks about, you know, in my temporarily restricted net assets, it's made up of these five items. You know, so much restricted for program A, so much for program B, a portion's time restricted, maybe it's capital campaign, right? We describe it, we talk about it. If we're not doing it, if we haven't done it in the past, then we're going to have to give more information. But certainly, I think from what we're seeing and what folks already do for disclosures, lots of us already comply. So this may not be a change for all of us. What may be a change is enhanced disclosure requirement also for the self-imposed limitation on the use of resources. So where a second ago we were talking about describing net assets with the external limitations, right? The donor restricted items, what is today the temporarily restricted. If we have board designated items, so maybe we have an operating reserve, maybe we have a capital reserve, right? The board has earmarked and maybe set some dollars aside for a particular purpose. Maybe we have a board designated endowment, right? So not an endowment created by a donor or an external party, but maybe there's one that internally has board imposed limitations. The new ASU is requiring some enhanced disclosures around those kinds of items. So this may be different. Again, some of us may have disclosed this in the past. If we didn't, we're going to have to do that when we start reporting using these new standards. Okay. It's interesting, in this standard, FASB has given us the option to provide disclosure on the face of the financial statements or in the notes. So just wanted to mention that if there's any potential way for us to succinctly, right, describe limitations, and we're easily able to do that, say on our balance sheet or a statement of financial position, we have the option to do so. I think that'll be kind of challenging to give the kinds of details FASB's looking for. So I think many of us will, of course, be putting that information in our footnote disclosures. Okay. So that's what's going on in terms of all the press that's happening around the change in net asset classifications. Okay. Of course, we know there are many other provisions. What we feel is the most major provision, and certainly David may have something to chime into around this as well. We got a lot of feedback, as he mentioned, in the in-person seminars we did and talked about this and heard feedback from folks in the audience, this new liquidity and availability disclosure. Right, so let's take a look at it, see what it's all about. Certainly write in questions to us if you have questions that come to mind, because this one is much different than sort of how we think about our financials currently. This is a new disclosure. It's future focused, which is very interesting, because if we think about our current financial statements, our financial statements tell us about the past. They report to us, of course, in our annual audit, everything that happened last year, right? Our balance sheet as of a date and time, statement of activities for the last year, cash flow for the last year, footnotes that give more information, a little bit of discussion, maybe if we have some contingencies or something like that. But our financials are historical. This disclosure is future focused. When we think about FASB wanting to give information to the users of our financials, really they're saying, hey, you know, financial statement users, potential donors and funders, we want to give you information so you can make decisions. And, you know, one of those decisions may be to support a nonprofit or not. We want you to know that they're financially viable, or have management give you information so that you can assess the availability of resources to meet their future cash needs. Right? So although we're going to report to them what happened last year, right, in our most recently closed year, we also have to tell them how we're going to, in essence, pay our bills 12 months from the balance sheet date. So it's a 1 year in the future focus. Talks about liquidity. We're going to see we have a calculation. We're actually going to calculate our available liquid resources. And it's all about, is the organization financially flexible? So it's interesting. It's certainly a different kind of thought process than other items in our financial. That's why we think this is so important. And lots of folks are having quite a reaction about having to disclose this kind of stuff. So what does the disclosure look like, right? We kind of understand what they're getting at. The disclosure has both a qualitative and a quantitative component, right? So let's start here on the right with the quantitative. It's a calculation. It's actually a calculation in numbers. It's going to arrive at the available financial assets. It's a calculation. It starts with balances on your balance sheet date at year end. And then it starts to subtract items that really are not available for you to spend on your operations, general expenditures, within 1 year. Okay, so you kind of get the gist. Maybe I've got lots and lots of liquid assets. Maybe I have cash and investments and all kinds of things. But maybe my nonprofit can't really get its hands on those dollars, right? Maybe there are restrictions around them so that we can't use those dollars to fund general expenditures. So this is what FASB is getting at, right? Help me understand what's on your balance sheet, but really tell me the real story. Tell me what you can use to fund operations. Because sometimes we look at balance sheets and maybe we're not the savviest readers of the financials, and we can't understand that. So we're gonna have to tell people. Does FASB define general expenditures? No. It's for each of our organizations to define that. So this is some of these decision points around this calculation. We're going to look at the calc too. So we're going to have a little table. We're going to do a calculation. Then we're going to describe in words. So this is the qualitative component. We're going to then tell the story of liquidity. So we're going to sort of then describe what's in the calculation. We're going to describe in words our plans to pay our bills for the next year. And we'll look at an example of that as well and give some more clarity around it. So how do we do this actual calculation? Remember, this is going to be a new footnote disclosure. We don't have anything like this now. We're trying to figure out what the available financial assets are on hand at the balance sheet date to meet cash needs for general expenditures within 1 year. So if we think about it, we know we have some amount of assets. Of course, we can't spend our fixed assets, we can't spend our prepaids, we can't spend inventory, and we have other kinds of illiquid assets. So really what we care about in this calculation are our financial assets, right? So items we can spend. And so for most of us, of course, it's cash, it's investments, and also it's receivables, right? So receivables are going to convert to cash, and so those are part of our financial assets as well. Cash or easily converted to cash, and that's our starting point. So then once we figure out what's in this financial asset bucket, right? The cash, the AR, pledges receivable, investments, then we start to whittle that down for items that are not readily spendable on general expenditures, right? We've got some amounts that sometimes, as we mentioned, might be set aside for a different purpose. So maybe I have a board designated fund that is, for a future capital expenditure. Maybe I have capital campaign dollars that I just can't spend on my general programming, right? So I start to pull out of that number items that are not readily available. Maybe in that balance, I have some kind of an endowment. Maybe I have some donor restricted amounts, and the donor restrictions are such that maybe it's for a more than 1 year horizon, right? We're trying to figure out here what we have on hand of a liquid nature that can be used for general expenditures within 12 months. So maybe I've got dollars and they're restricted for a 24-month period, right? So I've got to pull out of this available liquid financial asset number anything that I can't use within 1 year on my general expenditures. And that's the number that's going to be the ultimate result of this calculation, and that's going to be disclosed. Okay? And by the way, the calculation is disclosed as well. It's a little table in your footnotes. So we sort of talked about this greater than 1 year horizon, right? I just want to pause here for a moment because one major question that came up from lots of organizations is, gosh, this seems a little scary potentially because I'm starting with my balance sheet numbers. Well, what if, at that very year-end date, right, December 31st or June 30th, 2019, what if I just happen to be low on cash? Because maybe my cash is seasonal and maybe that's just not a heavy cash or receivable time. Then once I start whittling it down for items that may be restricted for greater than a year or not available for general expenditures, could this result of this calculation be negative? FASB has been explicit that yes, they can envision a set of circumstances where you have negative liquid financial assets. So this is sort of the fear around this, is that it will not present a great liquidity picture. And we're going to look, we're going to think about, we want to all think about embracing the qualitative disclosure here, right? Using the words that we've got to use in this disclosure to describe our plans for the next year to sort of overcome the way this calculation may or may not look. Okay, so I hope that makes sense to everybody. This is a sample calculation, and it really goes through the whole calc here. We don't need to sort of go step by step, but maybe let's look broadly at this. So here we've summed up our financial assets. So it's all the things we talked about: cash and close to being cash, easily convertible to cash. So cash, receivables, investments. Then we've subtracted items that are not available in 12 months for general expenditures. We have some long-term receivables. Interesting. We've got an endowment in there. We've got board designated reserves that aren't available unless the board votes to appropriate those for us. So then this organization is in a happy position of having liquid available financial assets of 662,000. Okay. Now, of course, 662 is, some folks are saying, was that a good number or not? Well, I don't know. It depends on your budget, right? And so a lot of interesting observations around this, but this is how the calculation might look.
So we're recommending, this is David Hollander, we're recommending that our clients and other organizations start looking at this now and start practicing. So create this schedule, present it to your auditors during the next audit before it's a required disclosure, and let's start looking at it together to see how your organization's disclosure is going to look, so that we could either plan around it or have a better understanding of how it's going to look, so that there's no surprises a few years from now.
Right. Right, for sure. You know, we can take, if we've got a report for 18, what we should be doing is, as David mentioned, we could use 2017 reporting if we're a calendar year as the dress rehearsal for this. So we'd sort of take the 17, see what the calc looked. This is definitely something that, is going to require conversation, especially around, we're going to see the qualitative disclosure coming up in a minute. This is an example of what we were mentioning in terms of FASB being explicit that your calc could be negative. And so folks are saying, well, gosh, how could it be negative? Well, maybe I've got financial assets of about 65,000, but maybe in my receivables, I have long-term receivables. I have receivables not expected to be collected in the next 12 months. So that's not really available, right? It's not even going to come in cash. I've got to back that out. And maybe I had a funder who paid me for a long-term, maybe I had, say, a 3-year foundation grant and got the money all up front. So you can see I've already spent money that was restricted for a future period. We know that this could happen. And so if that happens, we may be in this negative liquidity situation. We have to then disclose. We've got to then talk about explicitly the fact, FASB is saying we've got to do this, that we have not maintained the cash required to comply with donor restrictions. I think that's a pretty bold statement. This is what FASB is suggesting we may disclose if we're in this position, really being explicit that we've sort of spent dollars that were meant for the future. Okay. Now, of course, I always think that whenever we have the opportunity to use words, we should seize this opportunity. And for sure, we could give 10 people our financial statements with just the numbers, and we're going to get 10 different opinions or questions or thoughts or interpretations. So here is where, in our qualitative component, we have lots of opportunity to tell our liquidity story. So we're going to have a calculation, then we're going to describe in words what it means. So we're going to talk about our plans. We may talk about things like the fact that we have a line of credit, right? Maybe we're that organization that had the negative liquidity. And then maybe we go on to say that, yes, this organization has seasonal variations in cash flow. And by the way, year end, our actual year end is a low time for cash, right? And maybe that's the reality. Maybe that's why it's negative, right? So see how the story is really, really important. And then we want to talk about, perhaps during these periods of low cash flow, we manage our liquidity by maintaining a $100,000 line of credit with a bank, right? So we talk about that. Maybe we talk about the fact that we have an endowment, right? Or we have board designated dollars. They're not readily available, but could be made available upon a board vote. So you see where we're going with giving more clarity around how we manage cash flow. And this is what FASB wants. So those are the two pieces of the new liquidity requirement, the new disclosure. Again, if we are a calendar year reporter, our 2017 is going to be the last year, calendar 17 is going to be the last year that doesn't have this in it, but we can sort of use it to sort of pretend that we had to write it for 17 and see what it would look like, right? We want to sort of get ahead of it. Also give the board notice that this is going to be in there. What do you guys think about it, right? How should we frame this, especially if there is some sensitive information in there, okay? So now let's talk about a couple of the other provisions here. Of course, none of them are as heavy or potentially have the consequences of the liquidity disclosure, but we know there's lots of other provisions here. So let's touch upon those. Right now, lots of us report expenses in great detail in our audited financials. Some of us have this statement of functional expenses that gives us information about both the nature and function of our spending. However, not every nonprofit is required to show expenses by functional categories. Lots of us do, but we're not all required. What the ASU is saying is that everybody's going to be required. So now everyone's going to have to disclose, and we're saying disclose on purpose here, disclose expenses by their function. So when we say function, we're talking about, do we disclose expenses by program, right? General and administrative and fundraising. Those are our three functional categories. FASB is giving us options. We can show this on the face of our statements, right? So we actually can show all that detail on the statement of activities. I guess if there's not a lot of detail, if we're smaller, we might do that. It might get a little bit crowded there on the statement of activities. We could include this as a footnote. We actually can put that functional expense information as a footnote or in a separate statement. All right. And so we've got options here, but somewhere in our financials, we've got to show expenses by function. We also have to have a disclosure as to the methodology we use to allocate expenses. We also have to disclose if those methodologies are consistently applied. So that disclosure is important as well and can get kind of detailed in some of the examples we're seeing. And we have to remember here the focus of the FASB. And that FASB is trying to give stakeholders, users of our financials, again, information to make decisions. This is really, really interesting, is that FASB has called out the fact that this kind of reporting of expenses by nature and by function is useful for folks reading our financial statements to somehow make a connection between our service efforts and accomplishments and tie that into the cost, right, and how we're using our resources. This goes way above and beyond anything FASB has said before around a correlation between program service efforts and accomplishments and cost, right? So I hope you all agree this is a little bit different than FASB telling us how to do accounting, right? Or maybe what's required to disclose. So it's interesting. As a reminder, when we say natural classification, we're talking about what we're buying, right? What we're paying for. So are we paying for salaries, rent, utilities, supplies, right? What we bought. And then the functional is what we used it for. So was it used in program? Was it used in management in general? Or was it a fundraising activity by nature? So if we don't have all of this now, we're going to have it in the future. Now, don't get nervous about all the tiny numbers on this presentation. Really what we want to look at here is the format, right? So this might be what our functional statement looks like today. If not, if we don't have this today, this is what we likely will have in the future. A reminder, we know folks also look at the management in general and fundraising categories and sort of put those in this overhead classification and make judgments as well. Okay, so of course the allocation methodology here is important, right? Where we're putting the dollars, in which one of these categories. How do we know if it was program or if it was administrative or if it was fundraising? Maybe we haven't looked at our allocation methodology for a while, and maybe it worked 5 years ago, and maybe today it's sort of this legacy allocation that we don't know if it really truly represents our resource utilization. So if not, this would be the perfect time to refresh our allocation methodology, right? Let's look and make sure that, since there's increased focus on where we're spending, since we have to disclose the allocation methodology, let's think about if our methodology actually serves this purpose of allocating expenses in a way that helps us determine true cost of programs. Because really that's what we're trying to convey, is what it costs us to run programs. Now, of course, a disclosure of the allocation methodology might look like this, where we are sort of telling the reader of our financial statements the fact that, yes, we allocate expenses because sometimes expenses serve more than one functional purpose. And so we've come up with an allocation methodology we think is reasonable and consistently applied, and then we go on to describe what it is. There are some costs that we allocate based on square footage, and others we allocate based on an estimate of time and effort. So this is as detailed as it might get. But certainly, if we need to refresh our methodology, now would be the time, because we all know that consistency also is the key, right? When we do our accountings, we don't want to be changing things up every year. And before we pause for questions, let's take a quick peek at some of the other provisions. We're going to go a little bit quicker over these other items because they don't apply to everyone. The three we just reviewed are going to apply to everyone across the board. These others may or may not apply to your organizations, but we want to have heard of them. And if they do apply, then we know they're out there and we've got to get some more information. Okay, so we mentioned that there's some new disclosure around this situation that we're calling underwater endowment funds. Also, if we have a larger endowment or investment portfolio, we might have internal individuals that are really involved in investment strategy and tactical activities. So these provisions are all around our investments and endowments. The message here is that when I have an underwater endowment, that's when my market value, actually guys, I'm gonna go to this graphic and then I'll kind of pop back. When I have an underwater endowment, it means that I may have a requirement to maintain a certain market value in my portfolio or in a group of investments. But because of market fluctuations, my market value is under the value that I'm required to maintain. Okay, so through no fault of my own, the market's gone down and I'm in this position where I don't have enough market value. I'm less than what's required. So jumping back here, we see that we're going to need some enhanced disclosures around this. Okay, so more disclosure when I'm in this situation. Also, this is important. We used to be able to include that amount that's underwater, the loss. We used to be able to have the unrestricted bear the burden of the loss. We used to be able to show the endowment whole. Right? So for folks that have had this situation before, that likely resonates with you. The endowment would stay whole and the loss could be, it was almost like a borrowing from the unrestricted. We can't do that anymore. Okay, so that's what's happening with underwater endowments. So in our new situation, we have to classify the accumulated loss in our new category, right? Net assets with donor restrictions. The endowment's actually going to show that it's less. We can't borrow from unrestricted anymore. It has to be pretty clear that this stuff is underwater. We also then have to show in a disclosure the amount of the original gift, what is required to be maintained by law, really show the amount we're underwater, right? Be explicit there in the number. Then talk about in words if there are any actions we're going to take as a result of this situation, if there are any policies that are kicking into effect. We've really got to have discussion around ramifications of this situation. So our disclosure may look like this. Now, the qualitative part, the words here are truncated. We likely have more disclosure, but let's sort of take a peek. When this occurs, right, if we had an underwater amount last year, that used to be in the without donor restriction category, right? So in this example, we had $175,000 underwater at the beginning of the year. It used to be kind of borrowed from the unrestricted. Well, now we're going to make the unrestricted whole. So that's where the unrestricted here in our reclassification because of this. The unrestricted here is getting a boost, right? We've got a positive 175 because we're going to restore the unrestricted, right? We're going to forget about being able to borrow. The with donor restriction, right? The actual endowment now is coming down. Right? See, it's going to bear that burden. It's going to be reduced by that underwater component. Then we're going to talk about the fact in our disclosure, perhaps we say from time to time, right, because of market fluctuations, fair value of assets in our endowments is less than the balance required. Okay, right? And so we kind of spell out the fact that these deficiencies are recorded as a reduction in our net assets with donor restrictions. We actually spell out the fact that we're required to maintain $975,000. Fair value at year end was $779. Therefore, I am underwater by $175,250. And then the disclosure goes on to describe potentially the endowment investment policy, spending policy, method of appropriation, if there are any actions, if there's any actions to be taken as a result of this condition. Okay. And so as I mentioned, I know we went a little bit quick over that last portion. Really, it doesn't apply to everyone. Certainly talk to your auditor, your accountant, experts, if that situation pertains to you, because I know that folks who have that, there is some number crunching involved. Right, so although we went over it quickly, if you're in that underwater endowment situation, we recognize there's a little work involved in coming up with info for that disclosure potentially. Okay. So as a reminder, if we are a calendar year organization, we're going to start reporting this way when we do our calendar 2018 reporting. If we're a fiscal year, it's going to be in our fiscal 19. We know that 2017 would be a great dress rehearsal, right? So we sort of look to see what the 2017 numbers would look like in this new format and with these new disclosures. That way we can all be prepared. We can educate members of our board, leadership on the new requirements. Maybe it's a major funder and we want to talk to them about what they're going to look like next year. If, for instance, say we were in that negative liquidity situation, right? We want to put folks on notice and have them understand and seek professional advice, of course. Okay. We've got, well, say 5 or 8 minutes for questions. So I'd like to sort of open it up. Please use, I'm sort of scanning questions right now. Please use the written Q&A. So I've got a question coming in. So is board designated endowment treated as with or without donor restriction? So great question. Board designated is without donor restriction, without. So I believe all of you today will have access to, I believe there are these slides available as handouts. So check out that net asset classification section. That was our first section we talked about. It does give some examples indicating where the board designated items fall in the classification. And this is really a great question because we have to remember board is not external. So this sort of really highlights what FASB is getting at. Board has designated something. Board could also change its mind, right? Board could undesignate. So therein lies the financial flexibility inherent in something that is without donor restriction, right? Because if we wanted to do something different with donor restricted money, we'd have to go back and ask the donor, right? We don't have that flexibility, either management or the board, to make those kinds of decisions. So that's really, really critical that board designated is without donor restriction. And so inherently, board could undesignate and make those dollars available to us, right, to use in a different fashion or use in our operations. So that's really, you really touched upon exactly this idea of financial flexibility that FASB is getting at. So thank you for that. While folks are thinking about other questions, and certainly continue to write them in, we'll just sort of go through the last couple pieces of information. Like I said, you guys will have these links to websites, email addresses, ways to contact myself or David. So just want to go through these briefly, but please continue to write in questions. FMA maintains, with the help with funds from the Wallace Foundation, a website called strongnonprofits.org. So please go to that website. Lots of free, we like free tools that you can use in your organization. All kinds of neat items like budget templates, things of that nature, cash flow projection workbooks. So please check that out. Like I said, free. Here's my email address, Gina McDonald, that you can reach out to me at any time if you have any other questions after today. I'll let David in a minute talk about what White Owl and MBAF as well. David, before you jump in, I just want to answer one more question here. So there's a question around, is there a threshold for donations that raises the donor's audit risk with the IRS? So I would say, let me sort of take that question offline. It's a little bit different and a little bit outside of what we're talking about today. But for our friend who wrote that in, I've got your name down here. And maybe we'll table that as a side conversation around, it's more of a donor and IRS kind of question, but thank you for that as well. So David, if you wanted to say, we've got a couple of minutes here, sort of give folks information here about, again, if we need to sort of contact either FMA, White Owl, MBAF around these and other questions, it would be super helpful.
Sure. Well, MBAF is a full-service CPA firm headquartered in South Florida. We've got a major presence in New York. Coincidentally, both the nonprofit practice in South Florida and New York, you know, are probably one of the larger segments at our firm that we share both the same expertise in those two regions. So what do we do in those areas? Traditional audits and preparation of Form 990. So if you're a nonprofit who needs an audit or needs some consulting on internal controls, you know, please reach out to us. And then on the White Owl used to sell accounting software called Blackbaud, which works with nonprofits. Now they sell other accounting softwares, you know, like Great Plains, for example, that nonprofits use, and some other softwares that can make your office paperless. So they created their own software called PaperSave. So essentially, you could scan in documents as part of a journal entry or invoices as part of an accounts payable transaction and keep everything within your accounting systems at your fingertips. And that's a very inexpensive system that you could purchase through White Owl. And then you could talk about FMA a little bit more if you would like, Gina.
Sure, and I also want to be respectful of everyone's time because we're right at the hour. So let me just sort of shoot back here. So FMA, we're actually based in New York, but we are all over the country. I'm actually not chatting to you from New York today. I'm actually in Rhode Island, and we have a partner in Florida as well as the Bay Area on the West Coast, Chicago, and Boston. And we only work with nonprofits, and we are on the inside. So where David's, you know, external compliance, I'm helping you with your audits and 990s, and with White Owl helping you with your software, we're all about building internal fiscal infrastructure at nonprofits. So again, to be respectful of everyone's time, that's all I'll say about myself, but please feel free to reach out with any questions at any time about this topic or anything else regarding nonprofit financial management. So we thank everyone for joining us today and hope to hear from you guys soon, and we hope it was as exciting as David promised. Thank you, everybody.